Welcome back. Markets have been on a tear since Election Day. You know that. The S&P 500 is up better than 11% since November 8th. That does not mean everybody is participating. Tony Robbins is out with a new book that is a step-by-step guide to mastering your money. It is titled Unshakeable, Your Financial Freedom Playbook. Joining the conversation along with Tony is his co-author, Peter Mallouk. Good to see you both. Thank you so much for joining us. So Tony, you have access to the smartest guys and gals around in terms of these big money people, investors, as well as CEOs. You went back to them and you tapped into that and tried to get their secrets for financial planning.
Yeah, I spent 5 years actually doing it, went through 50 of them, from the Ray Dalio's, Carl Icahns, you name it, and tried to simplify it, but I put it in this huge book, and so I didn't want to write another book as long as I live. I hadn't written one for 20 years, but then I just saw so much fear, and like we talked about off the air, so many people waiting on the sidelines in the market. And yet, if you do the research and you understand the markets, not trying to time it, but just understanding historical records, like, for example, if you were out of the market, J.P. Morgan did a 20-year study, also Schwab did a 20-year study independently and what they found was that if you were out of the market the top 10 trading days in 20 years, instead of an 8.2% return that the S&P 500 provided during that time, you had 4.5. If you're out the 20 best days, you had a 2% return.
Wow.
You're out the 30 days in 20 years, you made no money. So the most dangerous thing has been out of the market. I know so many millennials, for example, that saw this carnage in 2008, and they've stayed out. They're still waiting, 250%. Or people, like you just said, since Trump came in, we're up 11.5% in 3 months.
No.
So you got to get in the market, and you got to stay there. Not only the market, you got to be diversified, but obviously it provides the greatest return over time, the greatest volatility, but the greatest return.
So you really want to look at your money over the long term. You don't want to say, okay, I want to get rich overnight, but look at, say, here I am in life today. Where do I want to be in 20 years?
That's correct.
And what do I need my money for in 20 years? So, Peter, from your standpoint, the big mistakes that investors make, you've got 5 big mistakes that investors make.
Well, one of the big ones is investors need to know it's time in the market, not timing the market. And if you look at, we were talking a lot about President Trump and President Obama and the wiretapping this morning on your show. And I had clients when Trump was elected, they just said, I'm going to cash because I think the markets are going to go bad. And the same thing, big mistake, same thing happened with President Obama. He became elected. Some clients said, oh, I would like to go to cash. Now, because of our education, we kept a lot of clients from doing that, but the people who did that with President Obama were severely punished. The people who have done it with President Trump have been severely punished. People take their personal emotions, whether it's from childhood or politics or whatever, and they apply it to markets, and markets are not that correlated to things that people think that they are.
And most people don't realize that that feeling of comfort, of confidence, changes everything in your life. I mean, why walk around with this fear that you have if you're invested?
But we just don't have the education. Look, we have a correction every year since 1900 on average. I mean, 116 years. Last year, you remember January, worst January ever. Everybody's freaking out, $2 trillion. We end the year with a record. 80% of those corrections, they last 2 months, about 56 days. Average correction is 14% every year. That's the average.
Wow.
But then we correct. 80% of the time, it doesn't become a bear. When does a bear show up? About every 5 years, we're due for one. It's been 8. They last a year. They cost about 33%, but they don't cost anything if you don't sell. And every single bear market in the history of the United States for 2 centuries is followed by a bull market. You remember 2008? 35% drop, 50% peak to trough. We did 69% starting on March 9th to the next 12 months.
So would you say that it's good? And I don't like timing the market. I'm not a short-term person. I like long-term. But would you say that if we were to see a big sell-off, I mean, let's say something goes wrong in terms of the policies coming out, and the tax policy doesn't come out at the right time, markets get upset, they start selling off. The next big sell-off, would you tell people you want to be buying that sell-off?
I would be ready for it for sure. If I told you if your favorite car was a Ferrari and I said it's 50% off, you'd be pretty excited. The stock market's the only place when things cut in half where everybody freaks out. If you won't invest now, when the market drops 50%, you're not going to suddenly become courageous and jump in. You really just have to be in, and you don't lose if you don't sell through the long term. We've seen it. It's like Jack Bogle always says, right? He says, just don't do anything, just stand there over the years. And he's got 65 years to show what it really means.
Do you go through the measure of, like, by age, the younger you are, the more you should be exposed to equities? How do you recommend somebody put an overall strategy together?
Well, we really don't look at risk that much. We don't look at age that much. I think one of the things that gets people to stick with a plan is to have the investments be needs-based. So if I've got some money I'm going to need in 20 years, well, yeah, that should definitely be equity driven. If I've got money I need in 1 year, it doesn't matter how great I feel about the markets. It shouldn't be in the stock market. It should be in something that's going to be available to me then. If I know I've got that 20-year horizon or the 10-year horizon for equities, and I've got that correction or bear market, I'm not that worried about it. I've got the time for that to do what it needs to do.
How do you focus on fees often as well? Because
without a doubt.
I mean, you know, with index funds and ETFs, people could get exposure to this market with a lot lower costs
and
than they know.
The average mutual fund, according to Forbes, is 3.12. When you ask a person, they think it's 1% if they know it all. And 1%, everybody's got to pay around 1% or less. If you're doing an index, you get down to 14 basis points.
Right.
But every 1% above those numbers that you're paying is 10 years of retirement income you're giving up. So if you're paying 3% on your mutual fund versus, let's say, 1% or less, you're giving up 20 years of income from that perspective.
Yeah, and that's not even included hedge funds, which are charged.
Now you're talking a whole different animal.
Ridiculous.
This man, one of the reasons I partnered with him, and I want people to know we're partners in business. I'm on his board of directors at Creative Planning. But why I did that is in 2008, this is a man who had a $500 million business, sounds big, but he grew up to $2 billion in 2 years with almost no advertising, because he told his people, here's what's coming, I don't know the timing, here's how we're going to protect you, and here's how you're going to make money. This is going to be the best time of your life.
Wow.
All of his clients went talked to everybody else saying they're losing money and came to him. Now he's at $23 billion.
Oh, my God.
But I want to just say that one of the great things that Peter did when I joined him, he came and told me about some of the exposure. He knows where the bodies are buried in terms of fiduciary. You know, there's a lot of people that say they're fiduciary, but they're playing both sides. They're a broker, too. And so he started exposing me to that. We decided to become partners. But one of the things I asked him, I said, you're taking care of billionaires and millionaires. How about the average person? You know, how about people who've begun their journey at least $100,000, build a new division? He's done that. So his ultra-wealthy client, if you wanted to get a second opinion from the #1 rated firm, they have a #1 rated, 3 years in a row on Barron's, he'll do it for you for free. But if you have as little as $100,000, he'll do it for you as well.
Wow.
So, and he does like a family office, takes care of everything. So that's why I decided to partner with him. That's why I wanted to write in the book, have him write, here's how you deal with the 2008, because he did it successfully.
By the way, that's a pretty good endorsement from the one and only Tony.
It was all right.
Yeah, it's all right.
If I could just take it with me everywhere, right?
But I also want people to know we've donated, and he joined me in this, which I'm grateful for. You know, last time I donated 100% of the profits. I was fed when I was 11 years old. We had no food. We fed 100 million people last year through Feeding America. I put up 50 million. We put matching funds. We did it the year before, and we're doing it with this book as well. So if you buy the book, we're going to feed another 100 million people this year. You'll be feeding 50 people while you help yourself.
Wow.
And you can't afford not to know. In 4 hours, you'll know how to protect yourself and how to profit.
I love that. I love that, Tony. Good for you. That's terrific. Tony Robbins, Peter Mallouk, great to see you. Congrats on the book.
Thank you.
We'll be following your work for sure, Peter. Still